Hi, welcome back. My name is Catherine. I am a multi-asset, multi-time frame trader. This is our third episode, and we are going to be going over trading terminology. Every trade has three components. You've got your entry, where you actually enter the market. A simple explanation is this is where the price is that I'm deciding to get involved. You've got your stop loss, the point where you accept you're wrong if you're wrong. So this is where you would take a loss. Why do we use a stop loss? It protects your capital, it controls risk, and it removes emotions. So it's your safety net. Then you've got a target, which is your take profit. The point where you take profit, this is where you get paid. Why do you use a take profit? So it locks in your profit, it removes greed, and it creates a consistency. When you enter a long position means that you buy in. So you believe price will go up. A long is bullish. Bullish is you're expecting higher prices. Your short position is you're selling. So you believe price is going to go down. Short is your bearish market. Bearish, you're expecting lower prices. So your risk to reward ratio, this is one of the most important concepts in trading. It's how much risk you're taking. So how much am I risking to make how much profit? So for an example, a risk to reward 1 to 3, meaning every £1 you risk means you can make £3. So why that matters is you don't need to win every trade. So every trade needs an entry, a stop loss, a target, you take profit, and know the difference between your long, you buy, your short, you sell, and always understand your risk to reward before entering any trade. Ask yourself, where's the entry? Where is my stop loss? Where is my target? What is my risk to reward ratio? And if you can't answer all four of those questions, then you don't have a trade yet. We're going to go into TradingView just so I can give you a quick example of what it looks like to mark up a chart, add a position, you take profit, you stop loss, your risk to reward. So let me share my screen. If you remember from the last lesson, so this is your TradingView chart, this is your time frames at the top, your pairs on the right hand side. So let's go to gold now, and I'm going to mark up on the chart as if I was going to take a trade or add an order, add a position. So right now we're on the daily time frame, and you can see price is in a downward motion here. It's been quite bearish for a long time, since I think it was March, the beginning of March. It's been very bearish. The the dollar index, that's flying at the minute, so that is sort of correlated with gold. So when DXY, the dollar index, is flying, gold tends to drop a lot. Right, I'm going to go down to the 4-hourly, and I'm going to get a nice supply zone here. I'm already in this trade from around here, which let's mark that up. So get my tool. This is the fib tool where I mark my zone. So here we've got a supply zone. So we've got a leg in, which is a leg into the base of the zone, and a leg out. So that is now my supply zone. So what I'm expecting, price is down here at the moment. I'm expecting price to retrace into this supply zone and then drop again. We'll go over this in detail in another lesson, but for now I'm just showing you how to mark up a position on the chart. So that's my supply zone, and then going to get my short position tool. So the green box that I'm going to drag to this previous lower low here is your take profit, okay? The red is your stop loss. So this red line here I'm going to place is my stop loss. So if price goes here and penetrates that red line, that means it's hit my stop loss and I'm out of the trade. So what I'm expecting is price to retrace all the way up to this zone, trigger my order, and then drop because it's in a selling motion. The market's bearish. The reason why it would retrace up into this zone is to take all of this liquidity. So where this zone is here, so that you had a nice leg in, so a bullish leg in, you've got your base candle, and then you've got a drop. These basing candles are where people are placing their orders. So price is going to come back here, take this liquidity, trigger all of these orders that are sat here, and then drop down. So this is your short position. So if I was right, I could be wrong, but if I was right in this trade scenario, this trade is a 1 to 6 risk to reward. So I'm risking 1% of my capital to gain nearly 7%. So it's a nice trade and it's not too far-fetched because it's on the 4-hourly. If I went up to the daily, then the risk to reward would be probably less. But because it's on a 4-hourly time frame and I'm only targeting that previous lower low, which is a conservative take profit, it's a nice risk to reward. So I'm only risking 1% and I would be gaining nearly 7% capital. So let me just reverse that and do as if we were going to buy. So we're going to long the market. So price is already down here. But if I was looking at a demand zone, which is a buying zone, I would mark up here, right? So I would put my stop loss at the bottom of that wick of that candle. And then I've got my red line here, which is, it's a 33% gap. The reason why we've got that 33% gap is because we experience, especially with gold, a lot of wicks. So these long wicks here can be a really quick movement that takes your stop loss and then flies in the direction that you were wanting it to go in. So we just give it a bit of breathing space to allow for those wicks. So that's the reason why I've got the red line there, which is the actual stop loss, and this is my zone. I'm going to get my long positioning tool. I would have entered on this. I would already be in this. If this was a trade, I'd already be in it now because it would have triggered my entry. I move the stop loss to the red line, just eating it up a bit. And then I would target this lower high here. I believe this is a bearish market. This would be a reversal trade. So I wouldn't want to put my TP, my take profit, to the moon because likelihood is it's not going there. It's still a bearish market. DXY's flying, gold's dropping. So I would only target that lower high because the chances are price is going to go up there, take that liquidity here, and then drop again, which is why I'm going to put a short position. I think I've already added one on my account. So that's where I would enter the market here on this demand zone. This is my long positioning tool. This is my stop loss area, my take profit. So this trade would be a 1 to 3, nearly a 1 to 4 risk to reward. So I'm risking 1% to gain nearly 4%. So let me just go back here. I'm going to stop sharing. There. So yeah, so the reason for that short video is to get you to grips with the terminology of your actual trade. So your entry, your stop loss, your take profit, your risk to reward, the reasoning behind the risk to reward. And I think in the next lesson, we will go over the supply and demand. So yeah, that's it. So thanks for joining, and I will see you in the next episode.